I've spent over 25 years in the financial services business, most of it in what you would consider to be the mainstream of the asset management business, stocks, bonds, mutual funds. A syndicate mortgage is where a number of lenders pool their investments together and fund a single debt. So it operates to that extent a little bit like a mutual fund where a number of investors pool their money together. But the important difference is it operates in all other ways like a mortgage, where you have a single borrower that is responsible for the repayment of principal and the payment of interest, and you have a real estate asset that's pledged as collateral in the event of default against the debt. Investors in syndicate mortgages receive 5 benefits. The first is yield. Typically these investments pay an above average yield, often 8% or higher per year. The second is security. The syndicate mortgage investor has their name registered against the property as collateral in the event of default. The third would be choice. There are a lot of real estate development projects in Canada requiring funding. So investors can pick the area of the country that they like. They can pick the style of development that they like. For example, high-rise condo versus low-rise residential. The fourth benefit would be transparency. Unlike a lot of other investments, real estate investing requires the disclosure of all material information by the borrower. So there's more transparency than what somebody might be used to in, say, a mutual fund investment. And the last benefit would be diversification. Most Canadians have a tremendous amount of their investment portfolios invested in the stock market, either directly or through mutual funds. Real estate investing offers a genuine diversification away from the stock market and introduces a new type of asset class into most Canadians' investment portfolios. Every time an investor looks at a syndicate mortgage investment, they can assess for themselves the capability of the borrower based on their past history, their corporate record, and the disclosed financial information that they receive. They can make a judgment about that borrower's ability to repay. And the collateral, at least, the land that's being offered or pledged as security against the loan, is also evident to the borrower. So they can make their own assessment about the quality of the location of that land and its suitability for the type of project that's being proposed.